Today we're going to be talking to you about the events surrounding the WorldCom scandal and the ethical impact this scandal had. The events that occurred leading up to the WorldCom scandal were that in 2000 a merger between WorldCom and Sprint was supposed to be taking place. However, by the end of the year, it was believed that the merger would result in a monopoly and the merger was canceled. This caused WorldCom's stock prices to drop. CEO Bernard Ebbers was invested heavily in WorldCom through stock options and could not afford to finance his other activities, such as building a cattle ranch in Canada, if he lost money from his WorldCom stock. Ebbers convinced the WorldCom board of directors to loan him over $400 million for what he said were business purposes. After he had been loaned the money, Ebbers had fraudulent journal entries made, which inflated assets by over $11 billion. Once the fraud was discovered, 30,000 jobs were lost and $180 million were lost by investors. In the late 1990s, the telecommunications industry was slowing down and WorldCom's stock was declining. The merger with Sprint was not being completed, which was hurting stock prices even more. Ebbers planned to show large growth through acquisitions, but at this time WorldCom was not growing. In order to make the company look better on paper, costs were being capitalized rather than expensed, and fake accounting entries were being made to inflate assets. WorldCom's internal auditing department uncovered $3.8 billion worth of fraud. Ebbers pressured the board into loaning him over $400 million for personal use. Ebbers also had fraudulent journal entries created to keep the stock price from dropping so he could capitalize on his stock options. Ebbers had an interest in WorldCom both as CEO and as a stockholder, so he was in a position to manipulate the company's books to benefit himself.
The stakeholders impacted by WorldCom's accounting scandal include the current shareholders, as well as any future investors, employees and customers of WorldCom, creditors, the general public, the government, and other publicly traded businesses that would be impacted by the laws and regulations that followed these events. All of the stakeholders involved were negatively impacted, with over 30,000 jobs being lost, as well as over $180 million of investor money. In 2002, WorldCom filed for Chapter 11 bankruptcy protection, the largest such filing in United States history. This came to a staggering blow to the credibility of the stock markets. Because of bad business judgments that were hidden from investors, stock prices continued to plummet due to a lack of confidence in financial information. This was also the tip of the iceberg for the government, who finally decided to address the current accounting scandals and pass Sarbanes-Oxley. If these bad business judgments would affect so many stakeholders, why would WorldCom commit these fraudulent activities? When the proposed merger with Sprint was abandoned in late 2000, the company's profitability took a huge hit. Additionally, Ebbers had a lot of money invested in WorldCom and wanted to capitalize on his stock options. Without the stock prices rising, Ebbers couldn't fulfill any of his goals, and he wouldn't be able to acquire more companies. WorldCom's accounting manipulations involved very basic, easy-to-spot types of fraud. Overstatements of cash flow and income were created because of WorldCom's major expenses, line costs, or fees paid to third-party telecommunication network providers for the right to access the third parties' networks were accounted for improperly. Essentially, line costs that should have been expenses, thus lowering reporting income, were offset by capital transfers or charged against capital accounts. Additionally, they inflated revenues with bogus accounting entries from corporate unallocated revenue accounts. Issues of accounting theory that were violated by this accounting scandal were self-regulation. Accountants were supposed to self-regulate the entries that went on the books, but instead of doing so, the accountants at WorldCom followed the directions given to them by Ebbers and made fraudulent journal entries. The point of financial reporting is to provide useful information to current investors, potential investors, and creditors. This information should be relevant, reliable, comparable, and consistent. But after the fraudulent journal entries, WorldCom's financial reports did not provide information that had any of these qualities.
WorldCom avoided recognizing standard operating expenses when they incurred. Instead, they postponed them into the future by classifying them as long-term capital investments. By improperly shifting these expenditures from the income statement to the balance sheet, they increased current income and inflated assets. They also reduced the amount of money held in reserves by almost $3 billion and moved this money into the revenue line of its financial statements. These changes turned WorldCom's losses into profits and also made WorldCom's assets appear more valuable. They also added a journal entry for $500 million in computer expenses, but supporting documents for the expenses were never found. Reducing line costs and capitalizing entries significantly improved the line cost ER ratio. According to its ratios, WorldCom always had a great financial performance. Market value of the company's common stock plunged from about $150 billion in January of 2000 to less than $150 million as of July of 2002. A lot of people were affected by the scandal at WorldCom. Evers was fired from WorldCom and sentenced to 25 years in prison and lost a lot of his assets. The chief financial officer and other executives were sentenced to prison and the controller resigned. But the biggest blow that had the most impact was that WorldCom filed for bankruptcy. The WorldCom scandal could have been avoided. Management and the board of directors should have been independent, and a company-wide code of ethics should have been instituted and enforced. There also should have been a chain of command in the company through which an employee can raise concerns or report acts of misconduct. Probably the best thing to come out of this scandal would be the passing of Sarbanes-Oxley. This act established that companies would no longer be self-regulated and address the corporate responsibility and consequences of committing fraud. The CEO and CFO must sign off on the company's financial statements and can be held personally liable for such financial statements. Now here's a short video explaining more about the WorldCom scandal.
One of the largest accounting frauds in U.S. history occurred at a company called WorldCom. Between 1999 and 2002, WorldCom overstated its pre-tax income by more than $5 billion. The overstatement was caused by aggressively and ultimately fraudulently reducing reserves and fraudulently capitalizing operating expenses. This Wall Street high flyer ultimately declared bankruptcy. Its stock became worthless. 17,000 people lost their jobs and their pensions. Investors lost billions. The principal players in this fraud all went to jail, including the CEO, Bernie Ebbers, the CFO, Scott Sullivan, and the controller, David Myers. By way of background, Myers worked for Ernst & Young for about 11 years before he left as a senior manager to work for a private company and eventually for WorldCom. For a variety of reasons, WorldCom found it could not meet its financial projections and Wall Street's expectations in the fourth quarter of 1999. Here's an excerpt from my interview in which Myers describes a conversation he had with CFO Scott Sullivan about the financial results.
In the third or fourth quarter of 1999, I personally brought financial statements into Scott and showed him a margin that was, in Scott's words, completely unacceptable. And his exact words were that we had completely, well, these aren't his exact words, that we had screwed up, that we had made a mistake, and to take the financial statements, he wasn't even going to keep them, they were wrong. So, I knew they weren't, but I didn't, at that point in time, didn't know enough facts about it to be able to tell him that he was wrong, so I took the financial statements back. We reworked the entire quarter and came back to basically the same number. So when I took those back to Scott, again, his response was, this is so far off where we had told the public market we're going to be, we can't do this. There must be a mistake. There has to be a mistake. Scott's probably the brightest person I've ever met in my life, from a financial perspective or almost any perspective. And when someone that you respect from an intelligence perspective, I mean, there's obviously a lot of loyalty and everything else. When he says that he knows for a fact that the information that you're providing is wrong, that you've made a mistake, you assume, or I assumed that we had made a mistake. And so we went back and reworked the numbers again, coming back to, for all intents and purposes, the same number. All of this time frame, we're a public company. Public company is about to release its quarterly earnings, And so the time frame to release your earnings is set. The time that we're at this point playing, trying to figure out what's wrong, is we're creeping closer and closer to the time we have to release our earnings. So Scott actually tells me, I know the numbers are wrong, I know what they should be, we need to book an entry to get where I know we should be, and then we'll figure out what the error is at the end of the quarter, and the next quarter is going to be just the same error but the opposite direction. The two will wipe out each other and everything will be fine, but you need to produce an entry this quarter to fix the problem that I know is there. And that was the real pressure that the accounting department was put under, was producing an entry that was based on the CFO's thought process of what he thought the number should be, as opposed to what we knew the underlying answer was.
Here's a list of our works cited.